The gentleman from California.
Thank you. Mr. Secretary, you've submitted about 900 pages of proposed legislation. I strongly agree with well over 90%. I commend your work and that of your staff and the chairman and his staff. I hope my colleagues have gotten this dear colleague letter that I've distributed. If anybody doesn't have it, please ask me. I do have a few extra copies, and Mr. Garrett has already put it in the record. Unfortunately, you've got in here what I call TARP on steroids. You've got permanent, unlimited bailout authority. This is the most unprecedented transfer of power to the executive branch to make decisions about both spending and taxes in history, all without congressional approval, and a sharp departure from our constitutional values. And depending upon what some future executive chooses to do, it authorizes the greatest transfer of money from Treasury to Wall Street ever. The bill allows for the bailout of both solvent and insolvent financial institutions. And Mr. Secretary, last time you were here, I asked you to embrace a $1 trillion limit on this total bailout power, and I'm still waiting for that embrace. Specifically, Section 1109 allows the executive branch to loan unlimited amounts to any solvent financial institution. When such a loan is made, the executives keep their jobs, the shareholders retain ownership of the company, and their shareholder and company value is dramatically enhanced. Section 1604 allows for the bailout of troubled financial institutions with unlimited loans and unlimited investments in the equity of the troubled firm. Now, when the troubled institution gets bailed out, the chief beneficiaries are its creditors. This will cause creditors to lend money on favorable terms to the systemically important institutions. Because after all, if the institution fails, the creditor will probably be paid by the government. However, the shareholders of the bailed out institutions also stand to benefit handsomely. The taxpayer takes the enormous risk, perhaps investing in the entity or lending money to it. And if things go well, the taxpayers get their money back, and the shareholders get a previously comatose and now revived giant institution that they reassume ownership of. Now, Section 1109 and 1604 provide a multi-step process for bailouts. The first step is that we transfer billions, perhaps over $1 trillion, to Wall Street. The second step is that the taxpayers are supposed to get their money back from a new tax imposed on large and medium-sized institutions. The proposed statute directs the executive branch to get our money back within 60 months and then specifies, or such longer amount of time as the executive branch decides, so it could be 60 years. I find it difficult to think how we would ever recoup from a single financial industry, particularly one in extremis, the hundreds of billions of dollars which might be necessary to repay the taxpayer from the next bailout. Now, the executive branch is empowered, and look at this from a constitutional perspective. The executive branch is empowered to write the new tax law. So how much money is paid by a medium-sized financial institution in your district, whether it's 100,000 or 100 million, is totally at the whim of the executive branch and can go up or down by that factor depending upon what the executive branch wants to do. The law will allow those institutions that are systemically important to borrow at a lower cost. This will help the largest institutions get larger so that they become a greater systemic risk. And by becoming a greater systemic risk, such an institution becomes even more bailout eligible, further lowering its cost of funds. Now, those institutions that are medium-sized are going to have to pay whatever tax the executive branch chooses to impose. However, they're not going to be able to get money at lower rates because savvy investors are not going to believe that local regional banks are going to get bailed out. So the medium-sized institutions will fund the program, which benefits only their large competitors. It's like being forced to pay insurance on your competitor's business while yours goes uninsured. Now, this tax is sometimes referred to as polluter pays, but it's hardly that. The financial institution that is the polluter, the one that took big risks and became insolvent, pays nothing. Instead, the prudent financial institutions have to compete with the high flyers in the good times and then pay to bail them out in the bad times. I yield back.
The gentlewoman from West Virginia, Ms. Capito.
Thank you, Mr. Secretary, for being here today.
Mr. Chairman, am I going to have a chance to respond?
Well, yes. If there's no objection, we'll take a minute to respond to this.
I just say very briefly because
let me say to the Secretary, you will probably have many opportunities to respond to Mr.
Can I just say one thing? I actually think, Congressman Sherman, we agree on much more than 90%. And if what you were describing is something I would oppose, and it is not what we have proposed. And I share very much your basic concern that we not create a system that would create those risks. I would be against that. I would not support it, would not want to have to live under it and administer it. And it's just not the proposal we're describing.
If the Secretary wants to correct any of my statutory citations, I hope he does for the record. I yield back.
The gentlewoman from West